Morning, guys. Happy Friday. It's June 6th, 5:34 a.m. Central Time. We're super late today. All sorts of technical difficulties. Brian Split is here wearing his agmarket.net shirt. You're looking very sharp, Brian.
Thanks, man. We have these if you in a lot of colors. So if somebody wants a T-shirt, just shoot me an email and we'll ship you one.
Yeah, he's going to send you free T-shirts. So how many emails are you going to get today?
I don't know. We'll see. But they fit really well. I actually wear this T-shirt probably in one of its iterations 4 out of 5 days a week.
I have one, and I wear it to the gym, and the women at the gym are just all over me.
They go crazy.
Yeah,
Absolutely.
yeah. Anyways, all right, let's start with this.
Alrighty, so soybean futures rose on Thursday, supported by renewed optimism over U.S.-China trade relations. The July 25 soybean contract climbed nearly 7 cents, settling around 10.52 per bushel. The uptick followed a phone call between President Trump and Chinese President Xi Jinping. The call reportedly advanced trade discussions, with both leaders agreeing to soon meet in person. Also on Thursday, Chicago wheat futures advanced amid rising tensions between Ukraine and Russia. Corn futures also ended higher, but slowing U.S. export demand limited gains in the front month contract.
So Trump says it's all good. Their negotiators from the respective countries will get together sometime soon. I guess maybe you can make the argument this is why soybeans bounced slightly yesterday. Maybe not. I don't know. I want to run through some charts with you, Brian.
Mhm.
This is July corn. It doesn't look very good to me.
No, I mean we went and we're within at these levels just over a dime off of contract lows. So the performance of July corn has been really poor. The performance of July corn relative to September and December has been really poor, and we just haven't been able to get any of these quick little bursts of buying to see any follow through.
No. All right. So December corn looks a little bit better. So talk about this in a vacuum, and then we'll get to the old crop, new crop spread.
Yeah, this one looks better. So you could see in this, the December contract's gone up for the last couple of days while the July's gone down. So we talked about that relative performance, but we've got some resistance right around 450. There was that peak, I think it was like May 12th, that little one-day high that reached 450. That was on a report. So we went back and revisited that. 450 has been riddled with resistance back and forth here, but downtrend off of those highs, that's going to be an important area. That looks like that comes in right around that May high, that what was that, 56.5 or so. And then you see the other side of 428, those are new contract lows. We're really not there that far from that level.
No. Okay, let's skip beans real quick. Okay, so here's July versus D's corn. The chart looks like an absolute dumpster fire. I mean, it's falling apart. In terms of fundamentals, how do you justify this action? Why did we go from a big inverse to now a carry in old versus new crop corn?
I think this just tracks the South American, the Brazilian values. And as we've seen the expectations of the safrinha corn crop grow over the last several weeks, I think that has taken value out of that spread and really made July look like it doesn't need to overperform, because we now have a very large safrinha crop that's come on deck, and Brazilian premiums have absolutely fallen apart.
Have you, do you personally subscribe to any of the other theories, them being USDA is overstating feed demand, USDA is understating last year's crop, maybe it's just a weather thing and the trade's not concerned about weather, therefore there's no need to chase these old crop bushels? Does any of that make sense to you, or you think this is not that complicated? It's just a Brazil thing.
I think there's an element to the feed part of it, but I think that the exports are still better than where we're at. So I don't think that's part of this spread. I do think that there is a very good possibility that the USDA overdid the yield drop in January, and maybe there's just more overall crop out there than what they're saying. But this spread is not trading like the expectation is for exports to go up another 100 million, and carryout's going to go to 1.315 for old crop. That's not the way this spread's trading right now. And I think the size of the South American crop took a lot of pressure off of the remainder of our old crop.
Yeah, that's the thing. Let's go to soybeans real quick. So we kind of, we looked like we were going to break out to the downside, then we kind of bounced out of it. We're still just choppy though.
Yeah, so that low that we made early in the week, we had taken out a whole shelf of lows for about a month and a half that we had made by about 2 cents.
Mhm.
And that low at 32 and a half actually was a 50% retracement from the April low to that May high. So we stopped right dead on the 50% retracement. But all we've done is really just kind of bounce back up to some resistance. When we were looking at those headlines and talking about, wheat was up on Russia, Ukraine, and soybeans were up on a positive phone call, I'd be more inclined to stay friendly the wheat market than I would the soybeans. I think the soybean market's continuing to fail at resistance, and we're likely to see that make another push lower here over the next 2 weeks or so.
All right, let's jump to weather.
The Corn Belt experienced mostly dry weather last week, leading to worsening drought conditions in northern Illinois, northern Missouri, Iowa, and northern Wisconsin. However, only 10% of the region is currently experiencing some level of drought, a significant improvement from 32% at the beginning of the year. Meanwhile, much of the High Plains received beneficial rainfall, resulting in notable drought relief across Nebraska, Kansas, the Oklahoma Panhandle, northeastern South Dakota, and western North Dakota. When we look at the percentage of U.S. areas experiencing drought, corn country 21%, soybeans 16%, winter wheat 12%, spring wheat 19%, and cattle country 21%.
Okay, so there's still some drought out west, Nebraska, most notably a little bit of South Dakota, parts of Iowa, northern Illinois, northwest Indiana, a little bit dry. There had been some rains, though, over the last week in some of those drier areas of the Western Corn Belt. And I'm looking at the forecast this morning, Brian. It's shifted dry for a lot of places, maybe most notably the Western Corn Belt. And even when you go out like through the 10-day period, both the GFS and the Euro, Western Corn Belt's dry. You go out even through the extended period, and I'm still not seeing much rain for the Western Corn Belt at all. I know the trade's not concerned, but should they be concerned?
Yeah, I mean, when you start to look at how these forecasts are evolving, and so this is kind of what the general weather guys in the industry have been talking about, is as we get into the later part of June, that Western Corn Belt really just continues to look dry. When we were looking at that drought monitor map, one of the focuses of where the dryness has been and where it could expand from is that pocket in the Southwest. And you look at like Southwest Texas across the border into Mexico, that is still extremely dry. So that's kind of what those guys were talking about, is that dryness moving a little bit further north, Western belt staying dry, Eastern belt continuing to get moisture. So this wasn't going to be like a 2012 type of a deal.
No.
But there's going to be definitely haves and haves nots, and the Eastern belt is going to have, and the Western belt is not.
I'm not an agronomist, but I know that some farmers would tell me, hey, I'm in Ohio and we started off too wet. And now if we stay really wet, I don't know if that's the best combination for yield potential. And then maybe opposite for the West, like we started off dry and it's probably fine for right now, but you're going to need that, inch and a half of rain every couple of weeks at least to keep things intact. Maybe it's too early, but maybe if the maps are dry Sunday night, maybe the market starts to react. I don't know. It's not too early anymore.
No, and I think there's kind of two different types of years, just anecdotally, when I think about like, all right, there's years where the market kind of goes up like January into spring, and then we make a spring high.
Mhm.
And then there's also years where we make kind of an early year high and then go down into June. And then it seems to me like those years, you might bottom around mid-month, late month, and then you get a very sharp, quick rally, and then it, typically would then peter out within a couple weeks, and that would be your summer high, maybe made in like late June, early July.
Yeah, and who knows? These forecasts could look totally different come Sunday night into Monday, but that's what we're looking at right
Absolutely.
now. Cattle futures had a hell of a day yesterday.
They sure did. The front month live cattle contract jumped 450 to settle at 222.90, and the front month feeder cattle contract gained 528 to close at 309.15. The rally was driven by a surge in fat cattle prices, marking the 8th straight week of gains in the cash market. Although trade was light on Thursday, fat cattle in the South reportedly sold for $230. That was $8 higher than last week. Strong market fundamentals also continue to send the market higher. Feedlots, specifically in the North, are incredibly current, and there is little evidence of herd rebuilding. As a result, historically low cattle supplies are expected to persist in the near term.
Brian got all excited when I threw the cattle chart up. So was that a gap higher yesterday and then just right into all-time highs?
Yeah, and so that's the August contract, and there was you would probably call that a bull pennant, right? So you had that April
A bull
low,
something.
very sharp move higher, consolidated in a little bit of a triangle, and then we gapped out of that triangle yesterday. The front month contract, the June contract, had kind of a little bit of a double top, and then it gapped right over those old contract highs. So the charts definitely picked up some momentum here yesterday. A lot of the people in the industry think we're in the process right now of having some type of a blow off, and that blow off could be several dollars higher from here. The futures are still at quite a bit of a discount to cash, but just some talk about not participating in buying feeders past the month of August and scaling back, and that's not the way to rebuild the herd. But I don't know if feeder demand is going to stay at the levels it is right now. But this is an absolutely incredible move. This has been 5 years of a bull market in cattle.
Okay, so you look at the dailies, and yeah, maybe you can make an argument that we're a little overextended or overbought. But you pull back and you look at the monthlies, and it's just it's still very orderly to me.
Mhm.
I mean, you look at a monthly cattle or feeder cattle chart, it's like a pretty orderly, like 4 going on 5 year uptrend. I mean, maybe within those trends you pull back and you see volatility, and we've seen that. But
Mhm.
I mean, there's zero evidence to suggest that the bull market is anywhere close to being over.
Oh no, I mean we just gapped it in new highs yesterday.
Yeah,
We're one day closer to making a high, but that type of move that we had yesterday
yeah,
is not a bearish type of a signal at all. And if anything, over the last couple of weeks, we've fought off some kind of daily reversals. There was probably
yeah,
what 1, 2, 3, 4 of them where the market went and made a high and reversed lower. A couple of those where we made a new contract high and then reversed lower, or we
yeah.
traded above the previous day's high, closed below the previous day's low, and it fought through all of that. So again, with cash trading where it is, this June contract still looks like it's undervalued.
Yeah. All right, let's go to export sales.
U.S. corn export sales slightly increased last week as net sales were reported at 37 million bushels. The print was up 3% compared to the previous week, but down 31% from the prior 4-week average. Mexico was the largest corn buyer for the week. Net soybean sales were near the lower end of pre-report expectations at 7 million bushels. The print was up 33% from the previous week, but down 30% from the prior 4-week average. Bangladesh was the largest buyer for the week. Net wheat sales for the next marketing year were reported at 16 million bushels. Despite a 37% decline from the previous week, wheat sales for the upcoming year have been strong. Unknown destinations were the largest wheat buyer for the week.
We have had a few comments over the last, I don't know, really over the last probably 3 months. And I guess that apparently the media, like the mainstream media, Brian, has been reporting about this fantastic demise of the U.S. grain export program, and that like Trump killed the export program and it's never coming back. It's never going to happen. I wanted to just run through these charts and give you guys some context. The corn export program is about as good as it's ever been. I mean, barring a couple of years. Soybean exports are like average-ish. Wheat maybe a little bit below average, but I mean, there hasn't been any big like massive death of the grain export program.
No, there hasn't.
That's fake news, guys. It is.
The corn export program's been phenomenal. That has been driven by Mexican purchases over the last year, which was really driven by a massive drought that they've been enduring for a year plus. The soybean exports, not fantastic, but we just had a record Brazilian crop. And so you think about the size of this year's crop versus last year's crop, and what are we talking, an extra 15 million-ish tons or more. So this is not, driven by anything to me to do with trade policy. This is
No,
just
it's
this
not.
is all fundamentals. And you could even go back to like the 2018 time frame, and everybody would love to blame that on President Trump at the time, but also we had a lot of pigs dying in China and they didn't need beans. So there was other elements out there to it, but they'll always spin it a certain way. Absolutely.
At least like 4 or 5 just absolute dumbasses are going to accuse me of being a Trump sympathizer because of what I just said. And have a nice weekend, guys.
The U.S. trade deficit posted its largest monthly decline on record in April. The trade deficit plunged to $61.6 billion, a $76.7 billion decrease from March. The sharp decline was driven by a significant slowdown in imports as businesses and consumers pulled back on purchases in anticipation of President Trump's tariffs. Imports dropped 16.3% for the month, while exports rose 3%. The trade gap narrowed most notably with China, as one would expect, which that posted a $19.7 billion deficit, followed by the EU and Vietnam. Despite April's steep drop, the year-to-date trade deficit remains 65.7% higher than the same period last year.
So the tariffs are working. Is that what this means, Brian?
Tariffs are working. I had to put new brakes on my car, and they were $400 more expensive than they typically would be, just for the part, because it comes from Germany.
Oh, you must be a liberal. I can't believe you said that.
What?
That's what you're going to be accused of.
My car comes from Germany. I had to pay.
No,
for
because
it. I don't know. I'm a consumer.
You're mad about the tariffs, and people like to jump to conclusions. They're going to say, "Oh, well, that must mean he hates Trump. He's a liberal."
No, I had to pay more for my brakes.
I know that, but the people watching like increasingly drive me insane with their comments. So what this has led to is an increase in expectations for GDP. So this is the Atlanta Now GDP forecast, which changes all the time. But because we've reduced imports, your GDP essentially gets better when that happens, because imports they result in you reduce GDP by that amount. The way the formula works, it's not a complicated formula. So people are asking like, why is the S&P at 6,000? Why did the S&P trade 6,000 yesterday? It's because of this, I think.
Yeah, I think it's because of this, and I think there's another element of just how much money the market believes is going to be made with technology and AI, and I think that's still a thing this market wants to invest in big picture, regardless of what's happening with tariff and all trade policy. There's some bigger picture things going on that I think money still wants to be a part of.
A little bit more economic news.
Jobless claims have risen to their highest level since October. Initial claims increased by 8,000 to 247,000 for the week ending May 31st, well above economists' expectations of 235,000. The 4-week moving average also rose to its highest level since October, increasing to 235,000. Despite the rise in new claims, the number of Americans continuing to receive benefits edged down to 1.9 million. Still, that figure is higher than it was at this time last year, suggesting that it's taking longer for folks to find new jobs. Economic uncertainty, tariff concerns, and reduced consumer spending continue to pressure the labor market. U.S. employers announced roughly 93,800 job cuts in May, down 12% from April, but up 47% compared to May 2024.
Some people will look at this and say, oh, that's not a good sign. But I feel like we're just kind of in a range that we've been in for 2 or 3 years. And then if you pull back and look at the big chart, I mean, it's nothing because COVID ruined everything. But I don't know. I don't see any recession indicators right now.
No, I mean that, like you'd said, that chart is in a trading range, and probably there's an uptick in. If you look at what a lot of the jobs that were added over the last year or two were government jobs, and I think we're cutting back on those a little bit. So that might be an increase in some of those numbers that we're seeing since the beginning of the year.
All right. That's all we got today. We covered cattle. Outside market's pretty quiet. Brian, anything to leave our listeners and viewers with before the weekend?
Yeah, just we're at the point here for if you're a grain producer where the next probably 30 to 45 days is likely to be the time frame where you're going to have to do a good portion of your marketing, especially for bushels that you want to be sold out of the field that you're not going to have in a storage. So this is really the time of year where you got to pay a little bit more attention and just focus on the market for a little while and get a plan together.
I think people are paying attention. They're just bored to death because
it's lulled us to sleep, and that a lot of times happens right before something special happens.
Yeah, hopefully. All right, guys, have a great weekend. We'll be back on Monday.